have expectations re-rated enough, whereas a beat is a beat, a solid thing, stock rallies, or do we need to price in more downside to earnings?
Well, that's a perfect question. I mean, we had an extraordinary contraction in the first half of the year. The market seemed to find some footing at the beginning of this month, and then we had those earnings last week, which were obviously disappointing. So I don't know if we're in the Goldilocks phase where we were too cold and then we got a little hot, and maybe this is just right, and the companies just need to report. But I think we're going to see some wild swings this week, like we've seen each of the last 2 quarters after these big companies have reported. My sense is the market is kind of at equilibrium. That is, we've probably seen the lows in tech, unless we see something monumental, if we see another black swan event like we've seen. But this is obviously the biggest week for tech earnings for the second quarter, and we're going to learn a lot about the back half of this year, I think, as they guide to the rest of the year, which is what it's all about. It's the forward-looking guidance that I think is more important than the rearview mirror.
Okay, so we're looking at the forward-looking guidance. It sounds like we're going to have to hold on to our hats this week then, Mark. How much divergence do you expect to see within the tech space on the back of some of the fundamentals that are changing and affecting these corporates going forward?
I mean, I think you're going to see a great amount. I mean, we don't even talk about FANG anymore. I mean, when's the last time we saw the FANG acronym on your screen? I mean, that's a big change. So these things have diverged. Obviously, Netflix had a disastrous beginning to 2022, and it's maybe in their mildly not disappointing second quarter that when the stock recovered a little bit, we saw that. So I think we're going to see wide divergence. Obviously, Facebook, now Meta, is a big harbinger for what's old and maybe potentially what's new. And we still don't know whether they have made that kind of leap across the transom. So I think there's going to be wide divergence. I think we're going to continue to see Apple kind of chug along and mildly beat expectations. Obviously, we've seen some companies that have wildly missed expectations. And I just expect this group to more diverge. And again, not to use the FANG acronym like we used to in 2020 and 2021.
We've seen some hiring freezes happening, also job cuts, Tesla, Meta, Microsoft, the freezes happening over at Apple. Mark, when does the freeze in hiring become like a real downturn? Because I'm trying to understand, are these companies getting defensive, like they just want to kind of safeguard themselves against a downturn, or is it really critical for them at this juncture?
I think it's both. I mean, you've had wild exploration of new businesses for a lot of these companies that you just highlighted. So I used to say, you looked at these companies like Amazon, they tried a lot of different things, right? They've already been in healthcare before. They tipped their toe in, obviously, they made a big acquisition last week, and they're doing it on auto, and they're doing it on video, and all these other things. Facebook, too. They plowed money, big losing money into things like Meta and like the metaverse. And I think Wall Street has told them by multiple contraction that, you know, the free money over time is kind of stopped. So I think they're going to get much more mercantile. I think they're going to obviously slow hiring, and that has its ripple effects for the economy. And we haven't even talked about some of the smaller companies that had unbelievable access to private dollars, to venture capital dollars, and that has also slowed. So as that slows, it kind of ripples through the industry. And I don't think that's such a terrible thing. Giving a couple of founders untold hundreds of millions of dollars to go for it is not a thing anymore. It was for the last 2 years.
Yeah, that cash burn of the gig economy tech companies. Mark, as we look to a potentially recessionary environment then, which of these tech names are kind of most resilient within that environment? Is it an Amazon with its kind of low pricing, or is it an iPhone, is it an Apple with that kind of stickiness around the product and the ecosystem?
I think Apple clearly is continuing to garner quietly more market share in some of the largest verticals. Obviously, we've seen it, what they're doing outside of there. So they're doing some of it in media. We're seeing some of it that they're getting into in healthcare. And I think quietly they keep building that foundation. But we're looking at some other tech companies that are growing nicely, but are just not valued the way they were in previous years. And I looked at one like SAP. SAP is one of the few companies that will benefit from a rising dollar. Their dollar-denominated their sales will obviously help their euro-denominated balance sheet and income statement. But they're trading at a huge discount to the market share. They have a cloud cycle coming through. They're getting off their old perpetual billing market. You look at that company that's trading at a tremendous discount and only 3 times revenue. That's a name that is wildly undervalued relative to the overall market. So you got to pick and choose.
Yeah.
Just buying the NASDAQ is not a good idea. But there are names out there that are growing nicely that have a product cycle like SAP that you'll want to pay attention to.
So let's get more specific on that, Mark, because my question is kind of where have we seen bottoms in tech? Like you mentioned SAP, but where are we sufficiently priced enough that you need to start buying?
I mean, it's a great question. I think we're obviously going to look at rates, and if the Fed does what we think they're going to do with a harbinger of some deflation coming ahead, maybe their heavy work is behind them. So we continue to like some of them. You mentioned Meta. We continue to like that. Amazon, we think, is trading for reasonable multiples. Booking.com is another name that we like here at JMP that has gotten, I think, a great tailwind from the rebirth of travel and luxury. And we think that Booking.com is another name we like. But again, you got to be very specific. Buying whole groups right now is not a good idea. We've seen that be the story for 2022. And I think that will continue to be the case. You get these huge opportunities when you have this big downdraft like we saw in mid-June. And then these wild flows upward. So you got to build your names, find the ones that you think are durable going into whatever environment the Fed puts us into. And then when we come out the other end, there's so much capital on the sidelines that I do think the kind of bearishness that we've seen in 2022 is at a harbinger for a much better 23.
Okay, a harbinger potentially for a much better 2023. Look, we touched on this, the cash burning, the profitless, the highly valued companies that a lot of investors are taking the knife to year to date. Is that a trend that is now coming to an end? VCs and the funding there, it's going to dry up, or does it come back when market conditions improve, when we get to a new normal? How do you look at that kind of space and the ability of those companies in the future to grow or not?
It's the right question. Listen, there are three phases that I think we've seen in the marketplace. We've seen valuations, which we could all say, obviously in the rearview mirror, that late 21 and early 22 were too high. That phase has completely were reverberated through the market. So at least in the public sphere, these stocks are trading at a much more reasonable level. On the private market, I think we're still slightly in that denial phase. So you look at a private market valuation, you can decide what you're worth on any given morning. You decide what you're worth in the public markets every day at 9:30 when the stock market opens. I think we're still waiting for that kind of capitulation on valuation in the private markets. We've seen some signs of that. That Klarna pricing certainly was the case. But on the smaller emerging growth venture names, not so much. I think that's going to take some time.